Hey, what's up everybody? It's Devontae Brooks here, your go-to mortgage expert who used to be an underwriting manager, and today we're diving into an important topic that's on everyone's mind: refinancing and when should you refinance. You may have heard that interest rates are shifting and you're probably wondering, hey, is right now the right time for me to refinance? Well, stick around because I'm breaking down the do's and don'ts of refinancing to help you decide if it's the right move for you. So let's get into it. All right, so first things first, what exactly is refinancing? Essentially, it's replacing your current mortgage with a new one, often at a lower interest rate. But while refinancing can be a great way to save money, it's also not always the best choice for everyone. It's very important to look into the data. So let's go over some key factors you should consider when you're looking at refinancing. The first do is evaluate your financial goals. Why do you want to refinance? Are you looking to lower your monthly payment, pay off your loan faster, or maybe consolidate debt and take cash out of your property? Understanding your specific goals will help you determine if refinancing is right for you. For instance, if you're planning on staying in your home for long term, locking in a lower rate could save you thousands of dollars over the life of the loan. But if you're planning on selling in a couple of years, the savings might not outweigh the closing costs to refinance. A common mistake is focusing solely on getting a lower interest rate. Yes, a lower rate is appealing. Let me be clear about that, but it's not the only factor that affects your savings. You should also look at the big picture of getting rid of private mortgage insurance. Let me give you an example that I had with a client recently. I helped the client refinance from a 7.5% rate down to 6.25%, and that saved them about $300 a month. However, they were able to remove PMI because the value of their property increased. That was another $150, so their total monthly savings was $450 a month. So remember, look at the overall monthly payment, not just the interest rate. Also beware of bad actors. I have a number of clients that get spam mail with BS rates on them, with the small print saying that they're paying thousands of dollars in discount points. So rate is important, but it may not fit your scenario that you're looking at. The next do on the list is explore different loan terms. So many people automatically opt for another 30-year fixed rate mortgage when refinancing, but it may not be the best fit for you. Consider shorter terms like 20 or 15 years if your goal is to pay off your mortgage faster, or if you're planning to move in the next 5 to 7 years, an adjustable rate mortgage or an ARM can be a smart and great option for you. ARMs often start with a lower rate compared to fixed rate mortgages, which can save you a lot of money in the short term. Now, here's another big don't when you go through this process. Don't ignore the costs involved in refinancing. Yes, there are closing costs when you refinance, and this can range anywhere from 2% to 5% of the loan amount, but the good news is that you don't have to pay these costs upfront or out of pocket. You can roll them into the loan. So make sure you understand your break-even point. And that's going to be how long it takes for the savings from the refinance to outweigh the cost of refinancing. So if you plan on moving before you reach that break-even point, refinancing may not be worth it for you. Another do is to consider a cash out refinance. If you're looking at consolidating high interest debt by using some of your home equity, you can pay off credit cards, auto loans, other unsecured loans, and roll that into your mortgage. It's a beautiful thing. However, it's going to be at a lower interest rate. So this is a win-win. This will improve your monthly cash flow and reduce your overall monthly expenses, but don't tap into all your equity because you want to maintain some type of cushion in case of emergencies or future needs. Lastly, don't overlook how refinancing affects your loan term. If you originally had a 30-year mortgage and you paid it down 5 years, refinancing it back into a new 30-year term means that you'll be making payments for 35 years in total. Consider options like refinancing to a 25-year term to stay on track of the progress that you made. So the question is, should you refinance? It depends on your unique situation. Make sure you evaluate all of your financial goals and consider the long-term effects of what you're going to do and understand the cost involved. Refinancing can offer tremendous benefits, it really can, but it has to make sense for you. Thank you for sticking around, and if you found this video helpful, don't forget to like, comment, and subscribe. And if you have any questions about refinancing or purchasing, feel free to reach out to me. And remember, if you haven't yet, you better call Brooks. I'm here to help you out.